And thank you for joining today's web conference, our CNR 2025 May Market Update. My name is Lindsay Cook, and I'm a Senior Portfolio Manager at City National Rockdale. I'm joined by key leaders from the CNR Investment Strategy team, including CIO Charles Luke and Senior Economist and Senior Portfolio Manager Paul Single. The views and estimates you hear today are sourced from our investment committee's weekly meetings. During today's call, we will discuss CNR's perspective on what's in store for the economy and financial markets and implications for client portfolios. At the end of the presentation, we will be on the line to answer any additional questions we receive from you during the webinar. So please type them into your console's Q&A window during any time during the session. You can also download the presentation materials using the downloads window at the top of your console. I'll now turn the call over to Charles Luke of City National Rockdale.
Excellent. Thanks, Lindsay, and welcome everybody to the webinar this month. The first thing I wanted to do today was sort of lay out our structure and what we're going to go through. So I know there are a lot of questions swirling out there about policy and global relationships, probably more than we can address in the prepared remarks. So what Paul and I have done this time around is shorten our content a little bit to give more time for questions at the end. So if you don't see us cover everything in our slides and you're curious about some other questions, I think we'll be covering those all in Q&A. So it's certainly another news-packed day. We've got the second estimate of GDP out this morning, a little bit worse than expected. We've got courts blocking tariffs under emergency powers last night and some more calls throughout the day on Fed cuts, as well as kind of a little bit of a rising market and lower interest rates. And I think it just underscores the amount of noise that we're dealing with on a day-to-day basis as we move through these types of markets. So to level set and to kind of get everything condensed into a specific funnel here, I wanted to come back to this slide that we've talked about before. And so if I had to condense this all into a nutshell, these are the real components that we believe have the biggest real-time, immediate influence on the broader economy. And this is also in the context of our four main long-term themes that I talked about and discussed last webinar of government debt sustainability, the monetary side of things, political uncertainty, technology and talent retention in the US, and then non-financial shocks like COVID and other natural disasters across the broader economy and countries. But the biggest components for the growth picture are listed on this page. Those remain unemployment, so generally are corporations and individuals making enough money? Inflation, so will wealth and spending be eroded? Tariffs and broader policy, what level of uncertainty will we be dealing with going forward? And then how the Federal Reserve is going to respond. So that brings us straight into the speedometers. We just met yesterday as an investment committee on the 28th, our monthly meeting. And we sort of had a lot of different discussion around any changes that we wanted to make and basically decided to not make many changes over the month of June. But we did have some pretty deep discussion around the speedometers that we did want to take a look at, although it didn't result in any changes. So I'll walk you through those. The first is that we have considered some changes to the fiscal policy metric. I think we were optimistic after the election that a lot of the policies related to the Trump administration and the goals that they had would lead to more fiscal policy and more tailwinds from government spending. That hasn't turned out to be the case, despite the big gap in the current budget bill. So we did have some of the members of the committee take fiscal policy down slightly, but that wasn't enough to move the overall speedometer, but we're certainly taking a look at that, and you can see that going forward. The other component that we talked a little bit about on the speedometers was the inflation outlook. So if you take a look at market-based measures, and I'm going to show you this in just a little bit, but it's actually improved a little bit in terms of where we think it's going to be at the end of the year. So we're slightly more optimistic on the level of inflation. This has a lot to do with potential tariff deals and what we could see with more positive announcements going forward based on the policy announcements that we've been through for the past 2 months. But generally, that's starting to look a little bit better, still elevated, but not in sort of the ranges that would have been considered extreme that we've been talking about prior. And then the last component of the speedometers that we took a hard look at was equity market valuation metrics. So certainly when the market did dislocate back in April, we hit the low on April 7th. Valuations were more attractive, so trading just below 18, now back up above that 20 level. But generally, across the measures that we look at, valuation metrics have slightly improved as we move forward throughout 2025. So again, no changes to that overall speedometer, but we could see that move more in the positive direction over the coming months. Now, moving on into our forecasts, again, we made these changes yesterday, but we decided to move away from showing you the tariff impact relative to our January estimates and move back to core estimates as we move forward. So as far as the 2025 GDP growth, we see that somewhere between 1 and 175. I'm sure Paul will have some comments around the GDP print, but personal consumption and investment remained pretty strong in the range of 1 to 175. What really pulled things down was the net import-export numbers. So I'm sure he'll talk through that. But we see about 1 to 175. Consensus right now is around 1.2 to 1.3. On the corporate profit growth side, we just finished a great quarter of earnings. So we've had about 92% of companies report so far. We just had some pretty good results last night from NVIDIA. So we're a little bit more confident to decrease our range there and move to about a 7 to 10% type of level, which is a little bit more consistent with what we saw in 2024. So despite seeing some of these revisions that we think are quite low as we head into Q2, we're pretty optimistic about corporate earnings, at least for the second quarter. The other area on inflation, I talked about this. I think at the margin, the expectations are improving a little bit as sentiment lifts here, but we see somewhere between 3.25 to 3.5 by the end of the year. That's caveated by the fact that we could see tariff pressure push us above about a 4% level on CPI, that's the Consumer Price Index. But overall, we think that's going to be a one-time impact and things should drift a little bit lower and resume some of the current trends that we've seen, which have been pretty positive. On Fed funds and the 10-year Treasury note, we continue to stay in the ranges that we've had. So we see 1 to 2 Fed cuts. They're very intent and resolute on sort of sticking to their guns and staying at these types of rate levels. So we see 3.75 to 4.25. Again, 1 to 2 cuts there. And then on the 10-year Treasury note, we have maintained that we see structural pressure on interest rates. We've got inflation, we've got debt and deficits. And so we don't believe that we're going to break that 4% level. And the risks here are probably tilted to the upside out of the range. But if you check into the market today, and if you look at the volatility that we've seen over the year, we're back below that 4.5% level, but it does remain a very critical level with the market, and especially with respect to equities. And we'll talk through that in just a little bit. So no change to Fed funds and the 10-year Treasury note forecast. So moving into taking a look at tariffs and how that's evolved since the last time we talked, I like this slide just because I think it puts everything into view. And that's that tariffs have now changed actually 22 times since March when they were originally announced. After I put this together, we had the extension for Europe, and then we've had the court challenges that just came through yesterday. And one of the things that this has created, and you've heard this word probably more than you'd ever care to hear it, but uncertainty has been high. But what we did see with some of the conference board numbers that got released late last week is an increase in confidence. So it was expected at a level of about 81, and it came in at 98. So that's about 12 points higher than where the last level was. So that was a stark departure from what we had seen over the past few months. And this has a lot of implications for our equity positioning, because seeing some of that easing around sentiment and some of these expectations points to what the market's been doing. And so it's been less sensitive to bad news and more sensitive to good news. And so in a sense, we think if there is continued resolution, which there very well could be, then we could see the market overshoot to the upside. And this can create upside momentum. So what we don't want to do is position our investors where they can't benefit from some of the resolution that may come. But based on the move that we've seen, certainly up over about 20% off the bottom in April, we're certainly getting a little bit more cautious and starting to think about some of those changes we may make if we do get some of those resolutions, or if we roll up to the end of June against the 90-day timeline and we're not any closer than we are today. That would make us a little nervous. So just to take a quick look at that court ruling and just to characterize it, and I think Paul will have some comments on this too, but last night, a U.S. court has blocked many of the tariffs that were put in place under emergency powers, and it spans across dozens of countries, essentially all of the reciprocal tariffs. And so what it could also do is eliminate any new tariffs on imports from China, Canada, and Mexico, and any other countries. So it could actually improve the prospects for the growth estimates that we're seeing, which have been declining. So that would be a positive thing. On the flip side, it certainly may scuttle Trump's plans around negotiations and certainly impair how other countries are looking at that potentially as an empty threat. So the administration is now appealing it, but if it's not successful in that appeal or doesn't get an extension, the court has said that the government will have to reverse some of these tariffs within 10 days. So definitely an element that's new here, and we'll be watching closely the implications for growth and also the markets. So let's get into the markets a little bit. I think this is a great slide to characterize where we've been, to take a look at what's really driven the return moves this year. So I'll go sequentially through each one of these, but if you look at the top left, that's the currency year-to-date return. So if you look at Japan, the Euro area, UK, Canada, China, and the US, you can see the stark difference between the return to the dollar and what's happened with other global world currencies, what we would consider sort of more hard currencies. And so when we take a step back and look at returns this year, some of the numbers are pretty tremendous, especially on the international side, but a lot of that is being driven by these currency flows. So if you look at the top right corner, these are returns to global equities in US dollars. So what's sticking out substantially is the Euro area so far is up around 24%. That's relative to a 3-year annualized average of about 16%. What also sticks out substantially is that the US is down about 1.2% relative to that 3-year average of about 15.1%. So in US dollars, those markets have sort of pulled more even in the post-pandemic time, given the returns this year. But that's not the whole story. If you look at the left lower graph, these are equity returns in local currency. So the specific currencies for each individual market. Now this is a very different picture. You still have the Euro area, which is up about 12% this year if you're holding euros and you're a European investor in European equities, relative to a 3-year annualized average of about 14. And if you're a US investor, you're still down 1.2, but that's relative to the 3-year annualized level again of about 15.1. So when we're looking at these differentials and trying to get back to the fundamentals and less about policy for long-term allocation, if the currency stabilizes, that does take some of the tailwind out of what we've seen with global returns. So we're going back to an environment that we're looking at growth. We do need to look at the currency translation and how that's impacting it, but also the stability of each country. And what you're going to see with the growth estimates that Paul's going to show you is that we are in a situation where global growth is declining and declining a little bit more substantially in some of the European economies based on tariffs and what could potentially happen there. So the other comment about the equity side is taking a look at sectors. So we've been talking about the divergence between sectors in the S&P 500. So you've got something like utilities that's up north of 8% so far year to date. And then something like consumer discretionary, which is in the direct crosshairs of tariffs, which is down almost 8%. So we've got a canceling out effect going on here. But to us, we like some of this dispersion that we're seeing in sector returns. And we do think that creates some opportunity. So our modeling right now is showing some opportunities in the energy sector, also in communication services. So think Meta and Google. And then some utilities, even those have run pretty substantially, but also the model's getting a little bit more optimistic around what we're seeing on the real estate side. So definitely some opportunities for positioning there. But I can't underscore just how important the dollar is. So to further characterize the impact of currency returns on the equity market, let's shift from taking a look at returns to overall valuations. So on the left-hand side, we've plotted the US versus Europe and China in terms of price to earnings, and focus on the green, that's Europe. So if we look at where US valuations were at the start of the year, they were about 80% higher than Europe on that metric. And they've since dropped below 50%. Now on the right-hand side, when we add the dollar into the picture, relative valuation strength or weakness has been highly correlated to the movement of the dollar, with US valuations rising when the dollar is rising and falling when the dollar is falling. So just the eye test on the right-hand side here, between the yellow sort of gold line and the blue line, shows you how important the trajectory of the dollar has actually been. So again, when we're thinking about this allocation between US and non-US going forward, you need to have a view on the dollar. And so here's how we think about it. Right, in the near term, the US has not suddenly lost either its haven status, in our opinion, or its ability to attract companies. Now, do we have long-term issues and is policy creating disruption? We sure do, right? But it doesn't change overnight. It does take some time. And if we think about the Moody's downgrade, the US was already a AA country by about 2 of the 3 ratings agencies. So it was largely expected. And when we think about liquidations from pension funds and endowments and insurance companies and things like that globally, they were probably already viewing the US as a AA country. So there's no forced selling or forced pressure or any sort of supply dumping that could be going on in the Treasury market. So it's important, it's symbolic. It certainly could be used in the debt ceiling debates coming forward. But in terms of market reaction, it was very minimal. Now, second, I think much of what drove markets in April and May was reactionary, and there's a lot of hot money that's related to that. So I don't believe the initial money flow out of the US is going to continue at the same pace. And in terms of other countries, I would characterize the current situation in just a simple way as a major argument in what has otherwise been a pretty good marriage. So something a couple needs to work on, but it's not necessarily a divorce. There's certainly different degrees of this, but I don't think we can just automatically conclude that all global relationships are just simply going to stop working. Also, this is not a political statement, but if we think about the current administration, the US system is set up that it will not last forever. It's going to change every 4 years. So I don't think we can get too bogged down with the here and now. We certainly need to be very focused on the policy implications, but things will change and time will pass, and there will be an adjustment that does happen. So what we have trouble doing as investors is just abandoning the US, which is still the most liquid market in the world with arguably the strongest rule of law, despite the policy issues that we're seeing. So I think at this point, it's still a big stretch to bet against the US, and we still believe that the long-term prospects are excellent. And if you look at what's happened in May, as the dollar has stabilized, equity returns have stabilized in the US. So it's actually outperformed European markets over the month of May. So I do think it's reasonable to reach the conclusion here that the US dollar may have bottomed in April, and that will be very good for our markets going forward here in the US. So again, I'll go back to the fundamentals. The calculus on US versus non-US needs to be growth, currency, and stability. But most importantly, it needs to be growth. So let's take a look at Q1 earnings for the US market. As I mentioned previously, it was a great earnings season. So if you look at the box up here on the right-hand side in the yellow, the gold, the projection coming into earnings season was about a 6.6% rate. And it came in at about 13.2, so almost doubling the expectations, with some standouts in the communications sector as well as tech. And again, the tech earnings were above expectations. We got good numbers from NVIDIA yesterday, so that caused a little bit of a lift this morning before we got the GDP report. But overall, the numbers here are very good. And relative to Europe, coming out of Q1 across the Eurozone, you're seeing about a 5.3% growth rate. So the US still does have the advantage in growth. And based on some of the GDP estimates, I am concerned about an economy like Germany, which is projecting about a 0% growth rate this year, and how that's going to filter through to the relationship between the US and Europe. And specifically, if the dollar does bottom, that's going to mean you don't want to be in Europe in that situation. So we're paying very close attention to that, but we do think that the growth edge is still here in the US at this time. So moving away from equities, let's start shifting over to interest rates, talk a little bit about debt and deficits, and then Paul's going to go into some deeper detail on that. But let me start by saying the deficit specifically, out of the debt and some of the other fiscal issues, is the major problem. And the policy jolt that we've had that's rippled through the world, it does certainly call into question the propensity for a lot of foreign countries to hold dollar assets. But if we go back, and you'll humor me on my marriage analogy, I do see a path through, and there's nothing to suggest that countries have been weaponizing treasuries in any capacity at this point. But I am very concerned about how we tackle the problem. And what you're seeing on this page is just an illustration, probably something you haven't seen, that just shows what this problem is, right? And it's the net international investment position. It's the difference between US residents' debts abroad and the assets overseas. And you can see that it's been widening. So that net position has been going negative. And just like a business, if you have your creditors that are calling your liabilities into question, that's going to start to put pressure on your balance sheet. So we worry about this, and certainly with the policy changes and a lot of the volatility, we're concerned that that could happen. But again, we're not seeing that happen yet in the market. So the biggest concern is the acceleration downward, just how quickly this is expanding. And so my question is just, what's the first step we need to take? And so if we look at this administration, what Scott Bessent has said and what we know, it does believe from its perspective that it's resetting global relationships, it's empowering the private sector through both tax cuts and deregulation, and it's reducing the size of government. So I'm not smart enough to tell you whether or not they're going to be successful with that with any level of certainty. But if we do consider for a second that it's the first shot across the bow, and at least maybe potentially they're on the right track, even though there's major disagreement with the tools that they might be using, like it could be the start of trying to tackle this issue. And the reason that I do say that is because of the consistency of what we've heard from Treasury Secretary Bessent. And essentially it's three things. It's getting a handle on spending, getting deficits to 3%, taking that initial step. Second, it's removing the risk premium that he believes are embedded in treasuries because of debt and deficits. And then the last is a little bit more nuanced, but trying to make some adjustments to US bank capital rules that may alleviate some of the pressure on mortgage rates and other interest rate sensitive sectors of the economy. So at this point, those are just words. I think there's a very fine line to walk in terms of success, but it is a partial step forward to fixing the issue. The other component that I wanted to address was the Treasury bond auction. So this is something that, that got me pretty riled up over the past month because it was just being reported incorrectly. But the main thing I want to get across to you here is that Treasury bond auctions are not weakening. So if you look at the left-hand side here, a lot was discussed about the 20-year US Treasury auction. If you look at the white line, the indirect bids, these are the bids that are coming from foreign buyers, was nothing special. It was right sort of at the midpoint, maybe even a little above the average that we've seen in the post-pandemic period. And then if you look at direct bids, so bids coming internally from the US, and then primary dealer bids who are absorbing the remaining amount, it's all very consistent. And you see the same sort of trend with the 10-year US Treasury auction. And keep in mind as well that when we talk about interest rates, it's been a global phenomenon this year. Interest rates have increased everywhere. So it's not just the US that's seeing higher interest rates after coming out of April. If you look at German yields, for instance, they spiked about 50 basis points almost overnight in late February. And so the bottom line here is when we're talking about interest rates, yes, we're concerned. There's pressure on them moving higher. But the 10-year US Treasury rate is almost 30 basis points or more lower than where it started the year. So a lot of the hand-wringing here has been created by volatility. It hasn't been a continuous march higher. But moving into interest rates specifically, when we think about inflation, I think a lot is being misunderstood about the level of inflation and expectations. So on the left-hand chart, these are short-term expectations, and all the blue lines, those are consumer estimates. So they're spiking substantially. But when we look at market-based estimates, they're moving a little bit higher in the near term, but not like we're seeing expectations. And that's because the pass-through of tariffs is not one-to-one. If tariffs go up to 17%, that doesn't mean prices are 17% higher. The rubric that we've been using is that about for every 1% higher in the effective tariff rate is going to result in about a 0.1% movement in inflation. So a 17% tariff rate, if we just stopped right here and implemented what we have today, would be about a 1.7% increase in the overall level of inflation. So higher, potentially dangerous, but nowhere near where the expectations are. And then on a longer term basis, if you apply that same logic, longer term market-based estimates are not anywhere even near what we're seeing in the shorter term bond market estimates. So still very stable, and overall long-term expectations remain below 4.5%. So there will be some pressure on interest rates from inflation, but I don't think it's going to be as bad as feared across the market. We're also seeing some very conflicting signals in the rates market. And I'll define term premium just very quickly here on the left-hand side, but it's defined as the compensation that investors require for bearing the risk that interest rates can change, can be volatile. So it can reflect volatility in the bond market. It can also reflect a concern around higher interest rates or overall debt supply. But what's happened this year is the term premium has moved higher, but 10-year treasuries have largely absorbed the change. So on the left-hand side, the term premium is the navy line, and then the yellow line is the term premium movement minus the movement in the 10-year treasury. So this would suggest that there could be some pressure on interest rates that hasn't yet been fully realized in the market, but that's balanced against where we are on a real rate basis. So on the right-hand side, the level of real rates that investors are getting is much more consistent with the 25-year average and represents a pretty good opportunity. So for our investors that are more conservative and have been in the bond market, we continue to think it is a good place to be. And if we back up from a 50-foot view here, except for munis, which are down around 1% on the year, nearly all global bond benchmarks are up more than 1.5%. So we continue to believe fixed income is doing its job, even in the context of potentially higher interest rates. But the last thing I want to leave you with is a little bit about our view on the equity market. And we are concerned about higher interest rates if they do shoot above our range, above a 4.5% level, what that can do to the equity market. So it's typically not been a very good sign. On this chart, you can see the different areas that are in the round circles. That's where we've breached the 4.5%. And then you can see the lighter blue line, which is the S&P. So we were sort of waiting to see what might happen if rates stayed above 4.5%. So far, that's been alleviated. We're at about a 4.42 today. But it is something we're thinking about when we take our positioning and potential moves around our equity exposure into account. So quickly, I'll run through my key takeaways and then hand it over to Paul. But the economy is being pulled in multiple different directions. We have policy decisions that we don't know how they're going to be made, how they're going to be implemented. Obviously, we have these global flows in debt dynamics. So we should continue to expect volatility. We know that tariffs have changed substantially, about 22 times at this point. But the key here is that markets are less sensitive to bad news and more sensitive to good news. Now, that can change. But we want to make sure that our investors do have some exposure to see if we have good movements that occur, good decisions on the tariff front, that they experience some of the positive returns we think could come from that. We know that the global equity market returns have been stunning, but they're driven by currency dynamics. So the run-up, especially in Europe, we think could be a little bit overdone, especially if the dollar does stabilize here. Earnings have been very strong. Growth rates have been very strong here in the U.S. But the key to returns is going to be the U.S. dollar going forward. So again, we're very focused on whether or not that's stabilized. We talked about the debt. We acknowledge that situation is unsustainable. Looking at the net international position just away from government is increasingly negative. And so the administration doesn't have a lot of time here, especially with the budget bill and the deficit that we could see in terms of adding to that. But we do think there are early signs, just in a vacuum, taking a look at what Bessent is saying, that we think could be somewhat positive later in the year and as we get through the term of this administration. And then last, in the bond market, it is giving some conflicting signals. We've got inflation, term premium, real rates all sort of dancing around. But we are concerned mostly about the negative impacts of higher interest rates on the equity market if the 10-year is consistently above 4.5%. So I'll stop there and hand it off to Paul.
Great. Thanks so much, Charles. And thank you all for joining us today. I'm sorry I'm having some technical problems, so my camera's not working right now. But I do have some exciting stuff to talk about regarding the economy. The first one here is in this chart. We're just taking a look at GDP for the first quarter of this year and comparing it to what happened last year. And this, of course, is an exercise that you saw on Sesame Street when you were young. You know, what here looks different than something else. On the left-hand side, it just shows the performance of GDP and the four major factors that contributed to that performance. And last year, growth was, on average, was 2.1%. And you can see the lion's share of that came from the dark blue, the consumption part. Government also added to growth last year. Almost all of that was state and local government spending. Just a very, very small amount of that was defense spending. Non-defense spending was flat. And then investment. You know, the stock market had been up for 25% in 2 years. Businesses were investing in the future, and we saw big growth there. But a big chunk of that was taken away by net trade. Net trade is imports minus exports. And since we imported more than we exported, and imports is a negative in the GDP calculation, that was a big drawdown in growth last year, taking away 1.5 percentage points. If it wasn't for that, GDP growth would have been 3.6%. Now take a look at the right-hand side. You can see the dramatic change in what happened in the first quarter of this year. And this is the data that was revised this morning. Almost 5 percentage points of negative number was a result of trade. Companies imported an awful lot of goods in the first quarter of this year in an attempt to try and beat the tariffs. Of all the imports that we get in the United States, 40% of it goes to businesses because there's something in there that you use to make whatever product they're making, like a headlight for automobile, that sort of thing. Government was a mild drag in the first quarter, mainly because of a decline in defense spending. Consumption was not as strong as what we saw last year. Last year, especially the fourth quarter, was people trying to rush and get products ahead of the risk of tariffs because they thought it might start as early as January. And in January this year, the weather was pretty atrocious around the country, and that kept sales down. But as the quarter moved on, growth in consumer spending was increasing. That's a positive sign for the economy. The investment, that had a big increase, but almost all of that was inventories. When a product comes in to the United States, as I mentioned, that's considered negative in the GDP calculation. As soon as that's put into inventory of a business, that's considered a positive. And if it all happens in the same quarter, they offset each other, but it didn't. So we'll probably see another strong growth in investment next quarter because of all the imports from the first quarter. But economists don't look at the overall number, that negative 0.2%. They tend to focus on specific components of GDP to get a feel of how the underlying trend or the demand level is in the economy. So they look at something that they call final sales to domestic private purchasers. And what this is looking at is the consumption component and the investment component without inventories. And the reason for this is they take out the volatile components that really have nothing to do with the underlying demand. I mean, government spending, that tends to be not cyclical at all and tends to be volatile. Trade is very volatile, and inventories is extremely volatile. So take those sections out, and let's just see how the economy is doing. So the line that you see here, that's the quarterly change in GDP, and you can see it was negative 0.2%. But the underlying demand, the consumption, and the investment without the inventories is pretty consistent. And that's why economists, including ourselves, have a positive view on the economy going forward, that the economy is doing really well. It can take the bumps and bruises from a moderate amount of tariffs, being the effective rate hopefully settling somewhere between 10 to 15% or so. The economy is strong enough to withhold that. But in terms of looking at what's happening around the world, here we're looking at the growth expectations of GDP for various countries and various sectors of the world. On the left-hand side, where we're looking at growth, the shaded area is for all of North America, and we look at the three countries that are involved. The United States makes up about 90% of that GDP, so that skews it dramatically. But you can see the United States in the dark blue. The pace of growth is expected to decline this year, in part because of uncertainty by many consumers, putting off big purchases because they're concerned about the future. And another part of that is investment. Businesses are unsure in terms of how they're going to proceed, so that will slow it down. But both Canada and Mexico are expecting to, or the financial markets are expected to see those two countries have slower pace of growth there. The middle one is dealing with Western Europe. Germany, of course, makes up about 25% of GDP for Europe, but you can see all of those have been trending downward pretty significantly. Now, keep in mind, trade is very important to Europe with the United States. Europe exports about 75% more than China does to the United States, so you can see it has an important role there. Because if you look over on the far right-hand side, in terms of Asia-Pacific, you can see there's not much of an adjustment there. And that has to do with the fact that a number of the countries there are very diversified, like Japan and India, in terms of their economies. They're not as focused on trade with the United States as much as Europe is. And even China. China right now, if you look back in history, right before Trump's first tariffs in 2018, about 20% of their exports were to the United States. The last year, that's averaged about 15%, so there's been a drop. And actually, April, China's already come out with those numbers. It was just 10%, so a much smaller portion, so the impact is much smaller. Here we're just taking a look at consumer confidence. We hear about this quite frequently. You can see on the left-hand side that it's near record low levels, and it really has to deal with the frustration in economic policies that are being put forth by the government. You can see on the right-hand side is the government doing a very good job. The dark blue line is yes, they are, and you can see that's dropped off. The light blue, the bright blue, that's that they're doing a poor job, and you can see it's 66. That's a record high. Not only is that a record high, it's 14 points above the previous record, which was back in the early 1990s when Clinton and Gingrich were fighting with each other. But people are quite concerned, and it's worrisome for many of them. And as I mentioned, it's weighing in on some of the big capital purchases that many consumers make. On the left-hand side, it's the inflation numbers. And just like Charles talked about in terms of the market aspect of it, here we're just taking a look at the economic aspect of it. The light blue line is the outlook for 1 year from now. The dark blue is for longer term, and that's really what the Fed is worried about, 5 to 10 years out. So it's thinking what the inflation rate will be between 2030 and 2035. Because if that increases quite a bit, it does alter people's purchasing habits. If you think of prices are going to move up an awful lot, you buy things now, which puts more pressure on the system, which raises prices now. So the Fed doesn't want that to happen. For many decades, people have not worried about it. But back in the 1970s and 1980s, that was part of the purchase. Things that you thought about, do I buy a car now or do I wait a year where it's going to be 15% more expensive? That sort of scenario, and that's what they're trying to stay away from. These numbers are really big. You can see we haven't seen them since the 1980s. Back then, inflation was at 15%. So with inflation down around 2.5%, 3% right now, it's quite shocking. And what's interesting is when you break down the details. If you look on the left-hand side, again, we're looking at both the 1 year and the 5 to 10 year area, that those people who think that inflation is going to be double digit, meaning 10% or higher, is quite high. In the next year, it's 29% of the population that thinks, 39% of the population that thinks so. And even the longer term, 29%. That seems pretty extreme. So the markets aren't overly worried about those numbers. They're looking at the other numbers, but it is something that's out there. Some people are quite extreme in their thoughts of what's going to happen. What's interesting is the financial markets aren't nearly as worried about. And this is important. These are, page too many. These are numbers that come from the yield curve. You have hundreds of billions, if not trillions of dollars being spent every day, on investments somewhere along the yield curve. So people are making an assumption for where inflation is going to be. And here, for the 10-year area, you can see that the number hasn't really changed a whole lot, and it's still hovering around 2 to 2.5% range. Another one, which is the Fed's favorite one, is the 5-year forward. Again, it's taking a look at where inflation will be 5 years from now for the 5-year period, 2030 to 2035. And again, the same thing. They're not too worried about it. So at this stage, the Fed is somewhat concerned about it, but not overly concerned about it. But they'll talk about it because they want to make sure that it gets pushed down. In terms of the inflationary pressures, this is an interesting chart. The columns represent the 3-month change annualized. So it's not looking at the month-to-month volatility because that's volatile. It softens it out a little bit. The line that you see there is the overall change to CPI. The green color components, well, those are services. The blue, those are goods. And for the last few years, goods prices have been generally in the negative territory, helping to bring overall inflation down. But it started to move back up, with the exception of energy in the last 2 months that you can see here. Those have been moving down. But there's the concern, because once you put tariffs on a product, prices are going to move up for the goods, and that may help push up some of those components. And that's why the markets and the Fed is somewhat concerned about inflation. But as Charles mentioned, that the tariff is not equal to the increase in inflation, because 2/3 of your purchases are services and 1/3 are goods. And not all of them are subject to tariff increases. In terms of how we're looking at the data, the best number that economists look at, the canary in the coal mine for them, is weakness in the labor market, are people losing their job. Because every Thursday we receive the data on claims for unemployment insurance. And it's based on data through last Saturday, so it's very, very timely. And you can see this on the left-hand side. It tends to be volatile on a weekly basis, so we look at a 4-week moving average. But you can see it's been hovering around the same level that we've seen for the last few years. Businesses are not ready to lay off people. Yes, they do see a slowdown in the pace of economic growth ahead of them, but they also remember what happened during the pandemic, where once they laid people off, it was very, very difficult and very expensive to hire replacements. So right now they're holding off. Another one to look at is continuing claims. These are people that continue to receive benefits for unemployment insurance. And when it's hard to find a job, we see this starting to move up. And it has moved up a little bit, but not much. To put this in perspective, during the tech recession in early 2000, it moved up from about 2 million to 3.7 million. We're nowhere near those levels right now. So right now, the labor market continues to look relatively robust. On the left-hand side, we're taking a look at some of the impact from DOGE. Now, Elon Musk has resigned his post. He's a temporary employee. He can only work 130 days, and that ends tomorrow. We're not sure how much we'll see of news items on it with him gone, but their actions will probably continue. I think it's one of the major focuses of the administration. In terms of what's happened with the workforce, on the left-hand side, the line, it just shows that data in terms of the changes that we're seeing in the federal workforce. The details of that has 1 month lag on it, but you can see different sections have been showing declines in workers. Some of that has been put to a halt because of a judge announcement saying that the president does have the right to reduce some, but he can't reduce significant portions without Congress's approval. We'll see how that plays out. On the right-hand side is just other data that comes out from the Labor Department in terms of the amount of openings. You can see in the dark blue, the amount of job openings is declining, and that probably is a result of movements that we've made, that have been made by DOGE, and we'll probably continue to see that, but not at an extreme level. In terms of the federal debt, there's a couple of ways of taking a look at this. The dark blue line is the total amount of debt, which is right now $36 trillion. Another way of looking at the debt is the net amount of debt, because although they've issued $36 trillion in debt, there are some government agencies that buy debt. Most notably, Social Security has a big portfolio of Treasury debt. So to look at the net difference, the privately held money, that's the light blue. Depends on what agency looks at it differently. If you're the Congressional Budget Office and you're planning and looking at the deficit, especially like the GDP, you look at the bright blue line. If you're the debt ceiling, you're looking at the dark blue line. In terms of relative to the size of the debt to the economy is over on the right-hand side. And you can see that we're near record levels. The level that you see in the dark blue is pretty close to what it was at the end of World War II. You can see the previous peak. Now, they would like to reduce that amount, but it is extremely high at this stage. On the next page here, you can see as a percent of GDP, where the total amount of debt right now, of private debt that is at 97%. And that's expected to increase up to 125% based on what the House of Representatives just passed. That's a big number. It's much bigger than it was during the end of World War II. Keep in mind, this is peacetime for us. There's not high unemployment. The economy's doing well. This is just the numbers that we have because the government, this is how much money they spend and how much they borrow just to run the basic government. The goal, of course, is to try and bring the down to about a deficit of about 3% per year. That's pretty hard to do right now. You can see on the right-hand side, interest alone last year was 3.1%. This year it's expected to be 3.2%. And by 2034, it's expected to move up to 5.3%. The government continues to spend an awful lot of money it doesn't have, and thus has to go in the market and borrow it and pay for it. So in terms of our overall outlook, we continue to expect an expansion of the economy. We do not see a recession happening this year. The trade fight that we're having, as long as it continues to be just arguing and not a trade war, then the economy will be able to survive it. Other countries will have a little bit more difficulty than the United States does, but we'll see how that proceeds going forward. Inflationary pressures have been quite low at the beginning of this year so far, mainly because of lower energy prices. puts the Fed in a much better position because it's fearful of higher inflation. So we still believe that the Fed will be able to lower interest rates this year by cutting the Fed funds 1 or 2 times for somewhere between 25 to 50 basis points this year. And as soon as this tariff stuff gets dealt with over the next few weeks, the focus will be mainly on the budget and on tax policy and on deregulation. So with that, I'd like to take it and turn it back over to have some questions that are very interested in coming in.
Perfect. Thank you, Paul. As Charles mentioned earlier, the team at CNR has been receiving several questions over the past month, and we've integrated them into this next section. So the areas we're going to cover are going to be policy budgets and the deficit, U.S. dollar inflation and international equity positioning, household finances in the labor market, and deregulation and competitiveness. So let's start with policy budgets and deficits. So Charles, the first question is for you. Are we finally in a regime where deficits and debt levels are market relevant? And what does this mean for interest rates and the follow-on impacts to other markets like U.S. equities and alternative investments?
Yeah, perfect. Thanks, Lindsay. So we hit on this a lot in the prepared remarks, but it is very difficult to unpack. And I think what we have to realize is there's going to be an impact if it's not addressed. And the first step to getting it addressed is for it to be in the public psyche and for it to become a policy issue. And I think what we're seeing is the budget bill is a huge gamble on the private sector, one in which I'm just not sure there's a high probability that's going to work. Now, I think we have to separate the impacts in the near term to long term. In the near term, I think it's going to affect sentiment and the general climate, but I don't think we're going to see a lot of short-term sort of devastating impacts from the selling of treasuries or other countries sort of just stepping away in totality. Right, I think it's going to come in waves over time, and certainly it's going to heat up the further we get away, I think, from the first year of this administration. But also, I think we need to keep in mind that this is a global problem. So by some measures, just for a comparison point, if you include local government debt, which is basically de facto federal debt in China, plus the federal debt in China, the debt to GDP is over 300%. So it's not just here in the US. We likely need a global government deleveraging to make all of this work. But as I mentioned, the market implications it's going to put pressure on interest rates. That's going to happen at some point. How much pressure happens this year and next, I think it could be relatively limited based on some other moves of the administration. The thing that could limit it the most would be if the world believes the US is on a sustainable path to fixing the problem. So that takes political will. And it takes a step in the right direction, and we're not close to that just yet. So it is a policy question at its core. There are also going to be some very tough choices around spending cuts. And so we just see the tip of the iceberg here with the proposed Medicare cuts in the bill. Social programs are absolutely going to be threatened by fixing this problem. And so to us, that could come with the price of lower growth. And if we have lower growth, a de facto environment of tighter fiscal policy, we're probably going to have somewhat of a threat to the overall level of equities, and valuations could come down. So I worry a lot about the follow-on impacts of higher interest rates. It's going to cost the government a lot of money, higher discount rates for equity. I worry about the impact on credit substantially. So we look post-pandemic, there have been very few instances of a wave of defaults, even as the sector of private lending has grown substantially. But if you're going to pay more for credit, more for money, and growth does flatline, I do think it's going to be harder to make your debt service. So all of those follow-on implications are very important. So net, there's no good outcome here if the debt continues to grow. It's going to create more and more pressure on markets. But I also think that we're probably getting into a scenario now where there's a lot of challenges of this administration, and so they may be forced to deal with this quicker. And I don't think the timeline is very long for them.
Perfect. Thank you, Charles. And the next one is over to you, Paul. What happened with the judicial ruling on tariffs last night, and what are the implications?
Yeah, it's an interesting decision that was made. It was done by the Court of International Trade, which has been around since the late 1800s, and that's all they do is focus on things that are trade related. And they said that well, let me back up for a little bit. Tariffs are an act of Congress. It's right in the Constitution. It's in the very beginning of the Constitution. But in the 1930s, Congress started to give the president authority to negotiate certain trade deals. It was done to FDR to try and get us out of the Depression. But it is really, in the last 50 years or so, there's been a number of acts allocated by Congress that gave the president even more authority. And so one of the acts is what he used to try and put the tariffs through. The court says, no, the act doesn't allow that. It doesn't state that you have the power to do so. Other acts do, like the ones that are used in 2018 against China. So you might use those as a reason for the tariffs. But this will probably be, or will be elevated to the Federal Court of Appeal, which is part of the Federal Circuit, which then, if you don't like that decision, it would go to the Supreme Court. We'll probably still have tariffs, but it probably won't be as extreme as has been feared. And this just gives a little bit more time. The problem is it creates a great deal of uncertainty for businesses in terms of investment. So that part might be a drag on the economy.
Perfect. Thank you, Paul. And now let's shift over to the US dollar, inflation, and international equity positioning questions that we've received. So this first one is going to be for you, Charles. Do the potential negative effects of the administration's policy and the inflation outlook outweigh investments in US dollar-based assets? What areas of the market can I own to protect my own capital?
Right. So I think this is a really compound question, but I do think there are a lot of different areas you can go in the market that can help protect you, if this is the trend that continues happening throughout this administration. So first, I think you're probably hearing a lot about TIPS and what TIPS can do for your portfolio. And while it can do better for you if inflation is persistently high, and by persistently high, I mean if you buy a 5-year TIP bond, inflation has to stay high for 5 years for you to really do well for that in that bond, right? So it's still an interest rate sensitive investment. When rates go up, the price of that bond is going to move down. So we're really not wild about it for direct exposure to hedge against inflation. But you're definitely going to be hearing about it more. For conservative investors, it really is an option. Clearly, real assets, when we talk about real estate and infrastructure, broader commodities are another tool that we can use. And you can get this exposure in public markets or through alternative investments. But keep in mind, if you're looking at correlations, the commodity market this year, outside of precious metals, which is sort of separate, has been relatively weak across the board. So year-to-date numbers are pretty bad. And commodities tend to trend, so they're much more tactical and less long-term holding. So you may see us make some moves there on the margin if inflation really becomes a problem, but it's not going to be a long-term holding. And there's also the issue of volatility in commodities, which can be very, very high, depending upon the market environment. But there are areas of the equity markets that can help you too. So if you think about energy, industrials, and materials, that could be a good place to own companies in an inflationary environment. And then also more stable stocks, so dividend growers, which you have kind of compounding income coming in. And then higher quality stocks can also help you, as well as I mentioned, infrastructure and utilities. The other areas that could work in this type of situation, and we're considering, our floating rate exposure. So we already do have some exposure there through private credit and other areas. And again, the corporate environment is very strong. The fundamentals are very positive. And then last, and it's sort of the elephant in the room, I think, Lindsay, is precious metals, right? So we can certainly see gold be a hedge against inflation, and we're definitely seeing that over the past couple of months. But we're certainly worried about its price right now and whether or not this is the right entry point based upon our outlook. So there are plenty of places that we can go. Again, we don't think the inflationary pressure is going to be too great. I mentioned that our outlook had improved a little bit, but those are the types of areas that we think about if inflation were going to be a persistent long-term problem.
Okay, and just a follow-up question on two other different areas that we're getting quite a few questions on. So digital assets this year, and then also your view on diversifying internationally with the outperformance and kind of what you see for the second half of 2025.
Yeah, sure. So, I'd love to talk about digital assets in the context of precious metals as well. So maybe to follow through a little bit from my gold comments, one of the reasons that, we haven't invested in an explicit position in gold is because of the way that foreign reserves work. So if you think about the US, it holds by far the largest stocks of gold, about 8,100 metric tons. Europe is a distant second. So when we break this down, about 75% of US foreign reserves is actually made up of gold. So there's an element of buying the US dollar, which is still backed significantly by gold. And that makes it a little bit harder for the dollar to decline. So that's another reason why I just don't see it continuing to move lower. And then just comparatively for other countries, gold accounts for about 10 to 15% of foreign official exchange reserves. So I think a lot of this buying in gold is driven by central banks, but I think that is going to come in waves and could be a potential pressure point. And again, I don't like this entry point. Now, on the digital asset side, and a lot of people sort of make the jump now from gold to Bitcoin or Ethereum and other assets. But I want to be very clear about crypto, right? There's been institutional adoption. You have the ETFs. It's easier to get exposure than ever, but it's still very, very unproven. And it's still hard to find the value in certain circumstances outside of just blockchain technology generally. So the way that we think about digital assets is more as a disaster hedge. And again, I believe in the US markets. We believe in the opportunity set here. So sort of abandoning the US or saying there's going to be a global war is certainly not in the place that you want to be. But if we were in a very detrimental situation overall, I do think that digital assets, could serve as a disaster hedge. But they're still very highly speculative assets. And I think it's difficult to hold them at this point, given the volatility we've seen this year, which has basically been a range of around 30,000 almost. So it's moving very, very quickly and very, very wildly. But that's kind of the use case that we're seeing now that we're taking a hard look at.
Great, thank you. And just a final question on international markets and what you're seeing for the second half of the year there, they've had such outperformance in this first half of the year.
Yeah, perfect. So, international markets, we hit it in the prepared remarks pretty hard, but I just come back to the foundational framework of what's going to drive markets long term. And I know everybody has probably heard, equity markets follow earnings, and they can separate from that, but generally that is true. So the element of growth and the differentials between the US and other parts of the world and the developed world is going to be incredibly important, probably the most important thing. And as Paul walked through, those revisions to growth are concerning, right? Tariffs and some of the policy right now, it doesn't just impact the US, it impacts the world. And they're going to be winners and losers from that. So growth is really what we're looking at, and we don't like what the picture looks like now. The other component is the currency side. So there has to be stability in currency. Being invested in the past 3 to 5 years and really exiting the international developed trade back in 2017, 2018, we benefited from that currency situation for quite a long time as some global developed market currencies depreciated against the US. We're down 9% on the US dollar. Determining that direction is going to be important, but I sort of skew to the fact that I think we've probably bottomed in the dollar this year. And then the last component is the stability of a government, the stability of an international framework and political system and market system, and also the geopolitical shocks that we can see. And so we're not satisfied with number one. We're not really yet satisfied with number three. And number two is really what's been driving the differentials this year. So we've just got to see more than that. And if growth continues to lag in non-US and we continue to have these geopolitical issues, I think that's going to win the day. And I do think US markets could continue to at least perform in line with what we see internationally. And then also I'd say in the current environment, getting through this year, the element of time, letting economies adjust to what the impact of policy and tariffs can be is incredibly important. So I'd almost say if we do have some resolutions, and we haven't seen a lot, but we have seen it with the UK, we've seen a de-escalation in China, all of those are sort of positive things. And with sentiment in the US, I do think that brings flows back into the US, does bring investors back into our market. So there is a dependency now too on this trade between US and non-US that is dependent on the policy outlook. But Lindsay, based on the way things have moved, it's been so volatile. You've got a sharp move in Europe with currency up 22%. So it's also a common sort of buy low, sell high situation where I don't want to go in at a poor entry point if we don't think the long-term sustainability of the trade is there.
Yeah, that makes a lot of sense. I'm going to move to deregulation and competitiveness as our last question. With this administration focusing a lot on the regulatory or deregulatory changes, Paul, I just wanted to ask, what are your thoughts on that and what should we be watching?
Yeah, I think we'll be hearing a lot more news about it as the year progresses. I think the way the administration set things up in terms of its agenda was get rid of the bad stuff first, which is an enormous tax increase that you find with tariffs, and then focus on other things like tax cuts and deregulation as you go into next year's election year, because that will have an immediate impact in terms of strengthening the economy. The administration, when it first started in January, said that they would get rid of 10 regulations for each new regulation that was added in. And they had a great track record in the previous in his first term as president, getting rid of an awful lot of regulations, and they're pretty much set up. They know how to do it. They've been looking forward to this for the last 4 years, so I think you can expect to see rapid changes. Some of it is in worker responsibilities in terms of regulations that are put forth by the Labor Department for workers. Some of it is going to be in health, but the biggest area is going to probably be in the financial sector. Ever since the global financial crisis, where Dodd-Frank was put in, raising capital requirements and increasing supervision of the banks, you'll see somewhat of a reversal on some of that. And that, of course, would help out bank stocks. That's why they got a jump initially when the president was elected. So, yeah, I think that is something that's very, very important to the president and will be a big campaign thing that I'll be talking about for the next election so that he can get more done in these last 2 years.
Perfect. Well, thank you, Paul, and thank you, Charles, and thank you to everyone for joining us. A brief survey will pop up shortly in your console, so please share your feedback and suggestions for future topics. A replay of this session will be available within 24 hours, and you will receive an email letting you know how to access it. Have a great day, everyone.
Thanks, Lindsay. Thanks, everyone.
Thank you.